As we take our step back and we think about where the direction of interest rates are going, middle market firms should prepare for higher policy rates and modestly higher rates at the long end of the curve. I think if I'm a middle market manager, I really want to be following what's going on in terms of the news in the high yield market, because that's where, if I have to go borrow, those are the rates that I'm going to pay, and that's how I'm going to be impacted by this. Inflation, albeit it will slow on the top line during the first part of the year. The expectation is that oil prices will bounce back. We'll see higher energy prices driving top line prices up in the second half of the year. Third, you're going to see some of the industrial space begin to slow significantly, especially if the trade spat turns into a trade war between the US and China. And retail, while it will be strong on rising wages, we expect wages to rise up to 4% during 2019, and a tight labor market where people are going to have an easy time getting a job, hang in there. But again, if we see that trade spat turn into a trade war, there may be a little bit of a price shock in the second half of this year. If you're worried about this because you see your business slowing and you're a middle market CFO or CEO, the one data that I would really urge you to look at is initial jobless claims, which are released on a weekly basis every Thursday morning at 8:30 a.m. Eastern. The way I look at it is I created a 13-week moving average. Once you see initial jobless claims and the 13-week moving average move above 300,000 on a sustained basis, then it's probably prudent to begin thinking about making my company lean and mean in order to be opportunistic during the next downturn. If I'm a US middle market firm and I'm thinking about what are my peers doing, how are my peers thinking, right? First, I would take a look at RSM's proprietary middle market business index. What you see is we're either at or near cyclical highs. Business is strong. Firms are still confident about the expansion at this point, especially over the next 6 months. Whether it's revenues, whether it's earnings, hiring, or compensation, we are seeing a very robust period of growth in the middle market. However, we can begin to see little cracks start to appear, especially around pricing. Middle market firms are clearly signaling to us in our survey that they are beginning to face cost pressures, and they're somewhat concerned about them over the next 12 to 18 months.